I think moving averages are one of the best first tools to learn in trading, but only if you treat them as a map, not a prediction machine. A moving average is just the average price over a set number of periods, updated one bar at a time. If I use a 20-day moving average, I am smoothing the last 20 closes into one line that shows the general direction without every small wiggle. That is the whole idea. Reduce noise and make the trend easier to see. The reason traders use moving averages is simple. Price alone can look chaotic, especially on short time frames. A moving average helps me answer a basic question. Is the market generally rising, falling, or drifting sideways? A rising average tells me buyers have been strong enough, on balance, to keep pushing the average price higher. A falling average tells me the opposite. A flat average usually means the market is not trending much, and that matters because many trend tools work poorly in chop. There are two common ways I use them. First, I watch the slope of the line. If the average is pointing up, I want to respect that as a sign of upward pressure. If it is pointing down, I treat rallies with more caution. Second, I watch price relative to the average. When price stays above a rising average, that often signals strength. When price keeps failing below a falling average, that often signals weakness. This is not magic. It is just a clean way to organize what price is already doing. The most common mistake is expecting the moving average to predict turns early. It usually does not. It lags by design, because it is based on past prices. That lag is the trade-off for smoothing. Beginners often buy simply because price crosses above a moving average, or sell because it crosses below one. That can work in some trends, but in choppy markets, it creates a lot of false signals. A cross is not a full trading plan. I also think traders overcomplicate the choice of length. Shorter averages, like 10 or 20 periods, react faster, but give more noise. Longer averages, like 50 or 200 periods, react slower, but filter more noise. A short average is useful for timing. A longer average is useful for context. If I had to keep it simple, I would say shorter averages help me see the near-term rhythm, while longer averages help me avoid fighting the bigger trend. Moving averages tend to work best when the market is trending and fail most often when price is trapped in a range. In a strong trend, pullbacks toward the average can offer useful reference points. In a sideways market, price may cross back and forth repeatedly, which makes the line look more important than it really is. That is why I never use a moving average alone. I want to know whether the market is trending, how strong that trend looks, and whether price is respecting the line or slicing through it. My bottom line is this. Moving averages are excellent for structure, not certainty. They help me simplify price, define trend, and avoid emotional overreaction. But they do not remove risk, and they do not tell me when a move is guaranteed to continue. If you learn only one thing, learn this. Use the moving average to frame the market. Then let price action confirm whether that frame still matters.